And we're back for another unmissable Sunday show. Slightly later than usual, as Benny couldn't tear himself away from the Masters. Go Rory. How are you, Ben?
Good. Another Masters in the book. Rory got the back-to-back. You know, got a little, fade the ceasefire looking better tonight than it was last week. What do you think there?
Well, I was just mulling the title of this show. Hormuz double lock is what we're looking at now, with the Trump tweet about the blockade. I mean, I have to say, I'm going to talk about oil and energy equities in a second, but why don't you kick off with what you prepped on, where we are in terms of equities and some interesting sort of back testing that you've done as well. Kick off with the consumer sentiment index.
Yeah, we got the University of Michigan Consumer Sentiment Index to come in at the all-time low. And, if you go to the next slide, you can see in those, Bloomberg only has it at 78. That's why I did two charts of this. If you can blame Bloomberg, I would have liked to have it in one chart. The times when the consumer index has been low, you've seen the S&P multiple been depressed, right? So the red is the S&P PE trailing 12 months. The black is the Michigan sentiment. We have a pretty wide gap right here, right?
Yeah, I mean, to be honest, I am getting a bit wary about sentiment indexes of any kind in an increasingly polarized political world. They are operating like political bowls rather than, true economic leading indicators, to be honest, right now. So,
and that's a fair criticism. But I would say this: I should have actually then put consumer stocks on top of this as well, and cut out Amazon and Tesla, because the XLY is only down 9-10%. But if you look at the Restoration Hardwares or the MGMs or the Caesars, or we can go across the board, consumer stocks are on their ass. I mean, we're getting close to 2020 energy levels for consumer right now, and it's so easy to be negative on consumer. So just in a 70% consumption of GDP basket economy, it's worth noting that most people are feeling like shit right now.
Yeah, well, funnily enough, my consumer shorts all ripped against me last week. So the restaurant,
because they were,
the Harley Davidsons, the Polarises of this world, but I'm not remotely worried about them at the moment, and particularly after the weekend news.
Absolutely, and just remember, it's because of it. We live in a pod shop world. Those guys got to be long something and short something. Well, there's nothing easier from a sentiment narrative thing to be short than consumer. You're like, well, AI is going to take the jobs, deleveraging, private credit money's not going to come in, rates are too high, housing's rolling over, blah blah blah, right? And now oil's and gasoline size, so it's very much the epicenter easy short for, and so you get a ceasefire, guys got to cover. And even like, Rupert, I told you, I bought Dave & Buster's into their print 2 weeks ago. No insight at all. I had no insight. The thing was up 30% and I sold it. And one of my buddies I work with was like, oh, should we buy more? I was like, no, this is literally just a positioning unwind of an easy short. It wasn't as bad as expected. And so I'm just saying, be aware that the S&P is very divorced from the sentiment of the average consumer in America.
Yeah, and it held your magic line. I mean, as we talked about, I'm not really a 300-day guy.
Yeah, I brought this back up just to show you, respect the first try of the 300-day. It's a real thing. We got an 8% type of bounce off of it, and where are we going now? I mean, that's what everyone wants to know, right? Like, no one wants us to tell us what happened because it's easy to see. And so,
yeah, I mean, my sense, just to start with an answer, is that, this doesn't look big enough right now.
It's interesting because you look at 22 and you had that move down that was sharp, and then you got a really sharp rally, right? That went back above that green line, kind of like here. And that's why I bring that up, of like, just to give a little Zoolander, nod. Is this that's a drawdown for ants?
Was that in February, right? I think it was
that
in
was
February.
a rally. It was in March. It went to the end of March, and then April 2nd, it started rolling over. So, you can't ever roll it to the exact day. But remember, it is tax week. There's some liquidity, like people have to sell stocks or take money out of the system to go pay the government this week. We got a good start. SPOs are down 120 bips. Qs are down 120 bips to start the week. Gold's down 240. Silver's down 400. Oil's up 800, 900. So, like if you were playing for a correction or like a reversal of the trend of the last 8-9 days, start to the month, or I guess started on March 31st, this is a good start to that, basically.
I tell you what, I've got a dirty confession to make. The squirrel rarely day trades, unlike his American buddy. But that bear market rally in Q1 22, I indulged in a bit of day trading that I daren't confess to, but it was about the most successful day trader I've ever had in my life, and it was long arc, Cathie Wood, intraday on a turnaround Tuesday. Yeah.
Last week was taco. I mean, it's almost like amazing that it was Taco Tuesday. It's like you can't even make it up. You're like, I had to send around the LeBron Taco Tuesday video.
Yeah.
But let's go.
So
here, remember, we've shown this chart before. I should have made the legends bigger. That's my bad. Sorry, guys. But this is the S&P divided by the 1 month vol. So we're vol adjusting it. And the one thing you can see is when you get a vol spike, S&P drop, these purple lines, those tend to be like tradable bottoms, right? So, we can go to the August of 24 Nikkei drop, the post-Liberation Day, November of last year, 2020, Powell steals Christmas, 2018, et cetera, et cetera. Question is, was this a tradable bottom or not? I think that's what people want to know. Like, it was a pretty good vol-adjusted move. And so what I'm going to talk about now is like how we had a 35% drawdown in the VIX. And sorry, that's fucking COVID just always misscales everything when it comes to vol. You can't see anything, So, but we went from a 31, 32 VIX. The S&P 50 delta wasn't as high, but like now we're at a 19 VIX. It will be a little higher tomorrow. And that's a 35% drop, right? And skew came down about 10, 20%. So let's look at the components, right? We've seen this chart before as well. Implied correlation goes from
Just
about...
Walk through all the lines for new watchers. Okay.
The red line is the S&P 500 high beta divided by low vol. So think about it like Palantir divided by Procter & Gamble, just to use two stocks, more or less, right? I mean, and it's a basket, but just to give an idea. And it's an inverted chart. So when it's going down, it means it's going up. But I wanted to roll it against to show when implied correlation's coming in, it's a vol suck, it's a vol compression, it's a risk expansion. So this high beta divided by low vol is a risk expansion proxy. And so they follow each other, right? And so we had implied correlations rise. I think we actually kind of called the bottom on that, Rupert, in January of this year, where I noticed, I was like, hey, this is coming off the mat. And you get a move from about 0.07 to 0.4, pretty big move. And then just got an absolute collapse. And one of the things I'm going to talk about here is what I think just happened is I didn't get time to historically rank it. So I don't want to make a statement, but it was a pretty good vol crush we just got. Is that a fair statement?
And it's 35% cross asset. We'll talk about bonds in a second.
Which is what I'm going to show. Yes, exactly. So the implied correlation now realize is coming up. But to be fair, if you look last year, you got the implied starting to go down and realize kept realizing, and then it rolled over. So this is basically something you need to keep an eye on. This is just to show you there's a very high beta. 3.5 to 4 beta on the decline in implied correlation versus the S&P change. And so it makes sense, right? Implied correlation comes down, you get a pretty good move in the S&P going up. And this is just weekly data from 2011 till last Friday, and you can see the very clear negative beta. So implied correlation goes down, S&P goes up, implied correlation goes up, S&P goes down. Very, very clear, right?
Being good
and so
trade.
Yeah, exactly. No, I mean, and it's gotten more pronounced as that, trade attracted more assets and it became more significant to the market, right? In 2011, that was not a significant trade. It was just something that was a feature, and now it's actually, very much.
Well, I think you mean it the other way around. In those days, it was a bug. Now, in those days, it was a bug. These days, it's a feature because there's so many assets concentrated in that trade.
Yeah, I guess what I was saying is it was an output then, now it's an input, maybe.
Yes. Yeah.
To use. All right. So, and to Rupert's point, cross asset. So this is the move index, and it's 4, components. And again, I've talked about it before. Everything except for the 10 years, 20%, 10 years, 40% of the weighting of the move index. And you can see we had a really good move in the move index. We were at, 60, and it got up to about 120 or a little bit, maybe 115 was the peak. And now we're back at 74. That's an enormous move, right? So you had a 40%-ish decline in rates fall, 35% decline in equity vol. I mean, so guys basically either got blown out or were hedging. And, let's go to the next one. And as everyone knows, I took a little pain finally because we took our hedges off. We got hedged into the turn, but then we took them off just a little early. And so last week was the first week probably since the beginning of the year, which was not fun. The first 2 weeks of the year I did not like. But since then, we were kind of masters of the universe until last week. That's why I started watching the Masters on Thursday. I didn't want to watch the screen. I just turned on Rory going on a tear like he did. Because I haven't made a trade in April, to be honest. And I said to some of the guys who follow me or pay for my subscription on Substack and some of the people like Rupert, the better way to fade the ceasefire, because if you didn't believe in the ceasefire, was to go long crude than short stocks. And I think that's proved out pretty well, right? Like crude's up 20% plus.
Yeah, we'll talk to that. We'll talk to that in a second. We'll come back to that.
Anyway, so high yield went from 409. Go ahead.
No, go. You finish.
Okay. All right, so yeah, high yield went from 4, like our CDS went on high yield, HY 45, 46s went from 409 to 340, caught a base there, kind of rallied into the close. They'll be up tomorrow, so we'll probably be back at 355, 360 tomorrow. IG went from 68 to 54, so we basically priced back in that everything was all good. And so my whole point of this is VIX down 35%. Move down 40%, credit spreads getting smushed. It was a great vol crush. So everybody who was hedged for World War III that was caught off sides just unwound their hedges. And then, in the way the market works, there was nobody taking the other side. And so we get a 500-point SPOOS rally, basically.
Yeah.
And so then here's the last thing I'll say, because we're trying to say, hey, what's next? So right now, stocks are down, but who knows? There was 2 things that happened from a, signal, statistical, technical point of view. And now that we live in an AI world, I can use Claude or my AI agents to just, boom, do it for me, which used to take longer. So now I can actually get through this back testing much faster. And we're going to put the data for the paid subscribers, we're going to put that in our Substacks so you guys can have the whole spreadsheet. But here's the summary statistic. There was 2 things that happened. One was we went from the S&P being below the 50 and 200-day and then opening the next day above. And so those are the summary statistics of what happens after that happens. For the most part, 65% win rate over the next year. And the only outlier is essentially the GFC. The GFC was obviously negative. And then the other thing that happened is we had 7 days in a row up. it's not as rare because with the bullish crossover, I think there was only 15 or 16 actual occurrences from 1950 to, so what's that, 76 years? That's a pretty rare event. 16 occurrences, 15 occurrences in 75 years times 252 trading days a year. Like it's very rare. There was 115 of the 7-day win streaks, but also fairly bullish with the exception of the GFC. So, I don't necessarily want to ever be, again, my firm's name is Deductive Capital. I believe in if-then, but I do think it's interesting to note empirical records. And so we'll put that on there for you guys if you want to play around with it.
Yeah.
There's the data and the summary tab.
The question for you, I mean, I am like you. I have pretty much sat on my hands throughout, where are we on? We're 13 days. In Australia, we're already 13 days into April. I've done very little, right? I look at that back test and that analog, and nothing is as, I mean, I respect the data, but nothing is screaming at me to strap on a ton of US equity risk here, right?
Totally agree, but I also like to argue against myself, and I saw this stuff and I thought it was interesting, and I thought I'd just throw that out for the listeners and our paying subscribers and all that stuff. That it's like, hey, look, I showed you that the vol had got crushed. Usually that looks like a tradable bottom. These things are supporting that. Doesn't mean anything. And again, I'm a bear, just so we're clear. But I would just like to not be one-sided, and I'm willing to entertain different things. I mean,
listen, there are plenty of people in the markets look through all of this. Everyone's pricing the other side. There are plenty of bulls out there, right? I've been nervous and rodent-like all year, and it sort of served me pretty well. But last week was painful because as I degrossed, starting mid-February into March, I didn't correspondingly take off some of my shorts on the other side. So last week the short book smashed me. The hedge book smashed me. So I'm actually sitting here.
Yeah, last week was the first week. Last week was the first week in a long time that I had a bad week, and part of being a partner is you gotta deal with your partners. And we were hedged into it and took the hedges off too early. It's okay, but I do think that you have to be cognizant of fundamentals versus price action, especially in a world now that's so dominated by non-thinking participants of price action, more than ever has existed in the history of markets, I think.
I agree. And listen, that gets me back because I wanted to talk about this is my favorite FinViz. This is last week's move in cross asset, right? Pretty much everything up except for energy equities, right? And that's in the context of obviously a collapse in the front of Brent. Well, and this is the WTI curve, a collapse in the front of the crude oil curve, right? And just to explain, this is two charts in one here. What the histogram bars are is how the shape of the WTI curve moved week over week. So actually, the further out you went on the WTI curve, oil was actually up all week. Inset, you've got the 30-minute chart of the XLE energy ETF, which got sold hard all week in line with the front month. Now, energy equities are not valued off spot crude prices, right? That's not how anyone's ever valued energy equities. So this is just a positioning sort of head fake to my mind. Anyway, I thought that was interesting to put together. I mean, the next thing I want to talk about is complete change of topic. But so just on markets.
Crude. I had a buddy ask me, and one of the reasons I also delayed the start of the show, sorry it's late a little today, is I was thinking I wanted to trade at the open because I was thinking, they're going to downplay this. And I thought SPOOs would open down 30 or 40 bips, and I wanted to short it. But I expected it should be 100 to 150. And I thought crude might only open up 400, 500 bips, and I wanted to go long. But I had a buddy ask me where did I think it would open. He was like 20%. I was like, no, it'll be 10. Right on the fucking button, 10% up. SPOs were down 1%, Bitcoin down 3%, and I was like, seems about right. And I think that a lot of people, and I had a couple other guys message me because I'm very popular when macro markets take over. Like guys don't talk to me when we're in vol compression periods, but during periods like this, I have a lot of inbounds. And he's like, well, the S&P is only down 120 bips. And I'm like, what did you expect it to be? It wasn't down that much that whole month, despite, 2 years blown up, gold blown up. Like, the S&P clearly was telling you it doesn't care about oil until there's some level. I don't know if it's 150, if it's 200. Like there's some level where the S&P will care about oil. But at 100, it does not, clearly.
Okay, there are two major paper oil markets in the world. You've got Brent and WTI futures. The real world is already pricing much higher oil. And it's just a matter of time before everybody starts to feel it. I think, the paper market at the front is a complete distraction.
Agreed. I'm just saying the U.S. is relatively much better positioned.
It'll get there in the end. It'll get there in the end, is all I'm saying.
But they'll be the last. So if you're like an asset manager, and where do I want to put money in? I don't want to be in Europe. I don't want to be in Asia. I'd rather be in the U.S. So you're like, hey, I can hang there, even though I don't think it's good for it, to your point, but it's not like as bad. Like TTF's up 7. Just so everyone knows, TTF is Dutch TT, nat gas prices. Yeah, exactly. 17%. Like Europe has a huge beta to energy, and so does Korea, so does Thailand, so does Vietnam, so does Japan. Japan and China have a lot of stockpiles, not maybe in LNG, but in oil, they were very well stockpiled. So they're not really there yet. But like, I'm just saying that is the riskier part right now. So yeah, sure, everyone can go to cash, but like, think about it. You went to cash on March 30th, even the 31st. You just missed that rally, and then the average guy's like, oh, I got to chase. Then now you're buying back higher only to get like dunked. This is what bear markets do. Bear markets are the worst. The only way to make money in a bear market is sell the rip. And you have to sell the rip after it, not the initial rip, because it's always like, it's too obvious. You needed like the pain rip, basically.
Yeah. Well, listen, I think we can carry on debating this over the months to come, because I have a different view on where I want to be long risk, once the straits are open. One of the things that I wrote about, the topic I wrote about this weekend, which is where people might want to do some work, is around closed-end funds, right? And a bit of a history. So these research report covers are from the early 90s, from my first job at Barings Securities, which is an emerging market investment bank. And when they opened up a new market, whether it was Brazil or Thailand, they used to come out with these glossy country books, which would be 10, 12 pages of macro and then company profiles of the top 12 listed stocks, usually a bank, a couple of banks, a cement company, and a brewery, right? And then in those days, nobody can trade. Even institutions found it really tough to get set up to trade in emerging markets, and so investors, institutional as well, needed access products. And so Baring Asset Management used to open a unlisted closed-end country fund at about the same time. And that would be the access product. And at times these would trade at premiums to NAV. And then of course, the institutions would get their local access. Us bankers would go and do GDR and ADR offerings for the big blue chips of these markets in London and New York, and gradually these funds would start to trade to a discount, and the trust busters would come knocking, and the Barings bankers would be hired to sort of liquidate, wind up, and restructure these country funds, and restructure them into open-ended vehicles or whatever. Got a picture of Bose Weinstein here. He's stirring things up in closed-end fund land at the moment. And really the opportunity here is that these vehicles, when markets are like this, start trading to really distressed discounts to NAV, right?
Yes.
And if if you and I've done some screening, which is in my weekend note, and if you line up themes that you like, and they can be geographical or sector themes, you're likely to be able to find one of these closed-end funds trading at 15, 16, 18% discounts to NAV. And provided you size very carefully, because you can assume that you can get and these things don't mean revert immediately. You can get stuck and it can get wider, but it's a really interesting way to add a sort of juicy kicker to returns if those discounts start to mean revert back to now. They're not going to go to par in most cases, but if they go from 15 to 5, that's 10 points on top of your total return, which is worth having. I owned a few closed-end funds into the downturn, but it's into the recent downturn. But the thing is, as soon as the market turns, you've just got to sit on your hands, right? I'd switch from an exposure to Mexican equities in a closed-end fund to the ETF in early February, but that was not because I was generally worried about macro risk at the time. It was more specific worry about the USMCA. So I flipped from MXF into EWW, and that allowed me to dance close to the door when it was time to really take off some risk. And so I didn't pay a double tax on the way out in the form of an expanded NAV discount. And just staying on the topic of this, I did a podcast before we started with my buddy Scott Osherov, who runs a Uzbekistan fund in Tashkent. Now, Templeton have just announced the intention to float for their Uzbekistan privatization fund. And I'm going to get Scott to come on, Benny and the Squirrel, in a couple of weeks' time when this comes out. But I've written about this at length. There's a detailed write-up from last November on my website. Please do check that out, because I think it's a really interesting opportunity to tuck away something in the coffee can. Because when this is going to come really, really cheap, and the economy is absolutely fascinating at this point. But we'll get Scott on the show to talk about it when we get close to that float date. Anyway, I was just going to do that, and then finally, the one last thing that I wanted to talk about was the Hungarian election. I think this is a really big deal. This is just the euro against the forint on a daily chart. It's actually the forint's opened 1.5% stronger against the euro this morning, so it's really blown below that range now. The March sell-off in anticipation of the election was when JD Vance was visiting Budapest to give the MAGA backing to Viktor Orban. That has backfired spectacularly, and I think that provided that the new administration doesn't waste too much time on revenge against Orban and his near totalitarian behavior over the last few years, this part of the world could be a really interesting place. They've got some big major banks like OTP, MOL, the energy company, Gideon Richter, the pharma business. I mean, those could be really interesting plays over the next 3, 6, 9 months. But I just wanted to flag that because it's all getting lost in the Gulf and Hormuz news right now. But it's a big deal, and it's a big deal for Europe. It's a big deal for Europe getting its shit together in this geopolitical mess that the world finds itself.
Yeah, because I think the way I understood it, and again, I someone who lived in Europe and multiple countries in Europe and loves Europeans, I've always been pretty negative on the EU and Brussels, and Orban has been kind of a thorn in the side of Brussels, as the guy who always kind of like voted against them, whatever. I was surprised because, and again, I don't follow Hungary politics that much, so don't listen to me.
As a European, I followed.
He was popular.
No, he was a populist. becoming increasingly unpopular, right? And we can see in other parts of the world how that's happening, right? Ultimately, you know, he was standing as an impediment to Europe getting its act together, and you know, with him out of the way, you know, he was employing his veto within the EU regularly. He was becoming a real thorn in the side to progress. This is really good news from a European perspective. Anyway, we've just hit the half hour. What have we got later on this week? Who's coming on Thursday, Ben?
We have Larry McDonald coming on Thursday of the Bear Traps Report.
Absolutely. Fantastic. We'll look forward to that.
Yeah, so Larry's always interesting. He's got his... Sorry, go ahead.
No. I was waiting for you. You were talking about Larry.
Oh, yeah. No, I mean, Larry's got his hand on the pulse. You know, he's got a lot. He talks to a lot of people. So it'll be interesting to see with everything going on, you know, what he's talking about. He was just in London. So we'll see what it looks like. But I think in general, it's a weird time because I think that everybody was ready to do the replay of last year of like, okay, Q1 and Trump taco on a Tuesday, and we'll see what happens now. You know, if the U.S. is in control, does that mean votes go through? You know, I'm not again going to sit here and tell you what's going to happen. I just think that like it was very obvious to me that like this story was not over, and the market really wanted to believe it, or it was just that the hedges were so massive that they just ran over, and there was nobody who wanted to be on the other side of that.
Yeah, I think that's right. I mean, listen, everyone, stay safe out there. I think there's a lot more risk out there than the bulls imagine. So we'll leave it there. Benny and the Squirrel out.